Saturday morning to you, and welcome to On the Mark, along with Mark Papa. I'm Gary Byron. Mark Papa is with Financial Resources Group. Financial Resources Group is out of Glastonbury, Connecticut. You can check them out online at www.frplan.com. FRPlan, Financial Resources Group. That's the FR. And by the way, while you're on their website, oh my goodness, you'd be completely remiss if you didn't click on the link that will take you to YouTube. Because Mark Papa has his own YouTube channel. If you miss any portion of this show or any of the previous episodes of On the Mark, they're all on his YouTube channel. He's so informative. Or if you just happen to be on YouTube, type this into your search field. It's Mark Papa, Mark with a K, M-A-R-K, and P-A-P-P-A, Mark Papa. 5207. Mark Papa 5207. And just sit there and have a field day. If it's inclement weather, if you need to kill some time or you're genuinely, sincerely interested in pursuing a meeting with Mark Papa and you're sitting there saying, you know what, I'm on the fence. What is this guy all about? I've been hearing some great things about him. He's so knowledgeable and informative. Listen to a few of these episodes. I think it'll put you over and you'll want to sit down with him. And when you do, here's his phone number to schedule that consultation. 860-657-8380. Well, here you go. I'll give it to you again. 860-657-8380. You meet with him one time, 30 or 40 minutes, or if you got questions, he'll stay with you as long as you need. He'll go over this checklist with you. You come back again. Again, this is complimentary. You come back for your second meeting. You review the checklist. You get a $100 gift card. Well, again, you don't need your checkbook. You don't need your credit card. All you need is 30, 40 minutes of your time. And by the way, forget the $100 gift card. I mean, you're going to get that. That's an automatic. The amount of information you are going to gain from this, it's heads and tails above what anybody else is doing. Mark, good morning. It's great to see you. By the way, happy July to you.
Yeah, thank you, Gary. Appreciate that wonderful info. I hope I have to live up to that.
You do. You do. People already they write the radio station thinking that they have no idea. They think you work here. I mean, if you worked here, you wouldn't be able to accommodate all your clients at Financial Resources Group in Glastonbury.
Yeah, but I do enjoy visiting though.
You've got a very popular show, and you are covering a lot of the issues that a lot of financial advisors just don't discuss.
Yeah, I would say that there's some that do. I would say we're probably not in the majority though. And I want to be on the side of let's cover as many things as we possibly can and then cover as many potential pitfalls and contingencies in your life. And, you just want to be able to enjoy your retirement, enjoy your grandkids, do your traveling. You don't want to be worried about whether your power of attorney is going to work with your bank next week. And those are the things we do. We uncover and we do the worrying. We uncover and we do the fixing.
And that's why people really do need to sit down with you. I mean, it's not even costing them anything. Just sit down and talk to Mark. He's going to bring up things that you're going to scratch your head and go, oh my goodness, how come my other financial advisor didn't do? How come you're so right. You're so dedicated to this field. But I hope you also, I know you work hard, you play hard. We're in 4th of July weekend. You're here in the studio. Are you enjoying the weekend? Are you spending time with your son and doing some fun family things?
I'll be heading out to Newport as well.
Really?
Yeah,
nice.
I'm going to head out to Newport to get on the road, grind it out, and take some time away. And definitely spend some time with my son. There's a pool, and there's a nice hotel, beautiful view of the bridge.
I love it. I haven't been
go
there in
every
years.
year,
I love it.
so I love it.
I used to. I stopped going a few years back. I should go back. It's fun. It's fun going just over the bridge.
If you're in New England, Newport's the place to be in the summer.
So true.
I'm all for it. So that's my place.
All right, so let's get right into this.
Yeah, speaking of 4th of July.
The National Association of Realtors have been sounding the alarm about what they call the ugly 11 tax increase proposals, which were part of that. Remember that Build Back Better plan under former President Joe Biden? This was back in 2021, but could resurface. Oh, please, I hope it doesn't. So for people listening, can you break down what this these ugly 11 proposals are and why they really should be such a concern for investors,
Absolutely.
as well as the real estate market.
I mean, Gary, I really would love to forget them. But
You and a lot of others.
no matter what happens with Build Back Better, and I know they're grinding that out. They're hoping to have a bill. But, here's the deal. I want people to be. I looked at this and said, well, this is kind of old news. This maybe not be the case. But then I was like, I did when you're just kind of sitting at your desk one day, I said, I haven't heard from these guys in a while. And I clicked on a video that came out to me from a company called Inland. And they're big on 1031 exchanges. They were pivotal in working with the National Association of Realtors, NAR, in working together to get these tax loopholes passed, 1031 exchanges especially, which is called a like-kind exchange. I'll get into the details in a minute. In qualified opportunity zones as part of the TCJA, Tax Cut and Jobs Act. We're taking money. So let's say you have a big capital gain, Gary. Let's say you had a big winner. Let's say you bought NVIDIA or you worked at NVIDIA and you had a big stock gain and you didn't want to pay a big tax bill on that. Instead, you wanted to donate that stock to a qualified opportunity zone. Now, qualified opportunity zone is going to be a economically underprivileged area where there's and it's got this criteria, underprivileged income, underprivileged school systems. Underprivileged is underprivileged.
Right.
But yet, we're going to start revitalizing the area. So we're going to make an investment. We're going to build, a strip mall, or we're going to build something that is going to have a positive economic impact. It's going to provide jobs. Things like food courts. Where people can go to work and as chefs or start maybe their own little restaurant. Or maybe an incubator for small businesses, for entrepreneurs, or a center.
Like this.
All sorts of good stuff. And that is actually being debated as to whether or not that needs to be extended. In my opinion, there's one more year left on that. And if it goes away, so with a qualified opportunity zone, Gary, you would be able to put your money in, defer it for 5 years. Mm-hmm. At that point, decide whether you want to pay your tax or get out or renew for another 5. If you renew for another 5 years, then at the end of year 10, whatever that investment exited at, you would pay no capital gain on. So it's a way to wash your capital gain, but you're also benefiting society in a huge way. And I thought that was massive because take a look at what we do around here. Okay, you got to go for the government grant, got to grind through the local red tape. You got to, get your grant writers in order, hope for the loan. Hopefully the government's going to back up the loan for the local banks. And then you got to corral all the banks to build this thing. And, it takes years and years and years. And by that time, the economic impact is mitigated. But what if you can have something like this? So that was one of the ugly 11 proposals where they wanted to get rid of things like that. So I can go through all the different ones. And
yeah.
The reason I'm talking about these things is no matter what happens with this bill, they're going to make the tax cut permanent. I don't know any time in history with our Congress, whether if they make something permanent, they can just create something new. Okay, so that might be, and again, with $37 trillion in debt, do you honestly think that at some point they're not going to want to take away certain tax benefits?
I think it was in the I think it was in the Big Beautiful Bill about rescinding, extending the tax credits when in fact to the deficit that you just mentioned. Maybe we should. I don't know. Maybe we shouldn't.
I mean, the big debate is over the SALT because you need to get some Republicans in the blue state.
Yeah,
with the
state and local.
State and local.
Yeah.
I mean, free. I mean, it's like you're basically, and just use round numbers, a married couple is getting a standard deduction of $30,000 up front, which isn't so bad. All right, but at the same time, the tax code prior to that was complicated because you also had, credits and deduction. It was just actually more complicated. It was But let me just get down to the nitty gritty here. So there's 11. So the ugly 11 increased tax proposals. I just wanted to give this to people as a reminder as to why it's so important to plan for taxes going forward. Next episode, Gary, we're going to talk about things like Roth conversions and why that's going to be so important.
I can't wait for that one.
Yeah. And because, again, I have a way to help people who do a Roth conversion have someone else help them pay the taxes. Number one. Ooh. Number two, with the tax mitigation business, actually help dramatically or not eliminate the taxes on that wealth conversion. All legally, all done IRS code. And again, IRS opinion letters are huge. But I want to remind people what could creep up on them in the future. And let's talk about number one, repealing of Section 1031 like-kind exchanges. Okay?
Yep.
And Gary, to keep this as simple as possible, a 1031 allows a real estate investor to defer capital gains by reinvesting proceeds from the sale of one property into another that's like-kind property. Okay? Mm-hmm. So let's say I had a 3-family in New Britain. I made money on it. I want to take a profit. And I see another 3-family maybe in Newington. Okay. That Newington maybe be a little bit more expensive, but maybe I can only buy a 2-family, right?
Okay.
But like kind, 300. I sell this for 300. I bought it for 2. That means my $100,000 because after I depreciate it and take my expenses,
it's capital gains.
I'd pay capital gains on the $100,000, so I'd pay $20,000, right? Mm-hmm. Or more actually, because that not to get too technical, that $20,000 is going to get added onto all my other income and put that into a higher bracket. But I want to remain a real estate investor and say, you know what, I don't mind exiting that property. I made good money on it, owned it for 10 years. Why don't I buy something a little bit more chill? I'm going to buy a duplex in Newington, right? And for $300,000, I can just transfer in that property instead of paying that capital gain.
Like a quit claim? Would it be a quit claim? When you say transfer it, what kind of a transfer?
Well, no, what would happen is...
Are you selling it? Are you quit claiming it? Are you gifting it?
No, you're actually selling one, and you're going to say you have 45 to identify the new property and 180 days to close.
Okay.
And by the way, correction from like 4 episodes ago, it is 45 days to identify the property and 180 days to close.
Okay.
But you put into purchase and sales contract, and this is for the attorneys, they'll make sure that it's all compliant, that it's going to be a 1031 exchange. And this way you don't generate a 1099-S to the government saying, hey, these guys owe taxes on the sale. Because it's a business property. It's real property. Okay? So what you have to do, because it's rental property, so then you can just flip it to the new one and pay no taxes on the capital gain. Now you own and you have a new property.
Really?
Yes, really. So this is the basic version. Institutions do this stuff all the time. So you have pension funds, right? You have private equity funds who pension funds invest in. So imagine if they took away this tax, Gary, the negative impact this could have on people with pensions, people who are just small business people trying to get ahead. You know what it would hurt a lot? And I'm going to just say this out bluntly, minorities. Minorities that I know, they're not as many stock market people. I'm not saying they don't invest in the stock market, but a lot of the tax returns I do, and these are guys, MBA, they have masters, but they're living in Hartford, and they're the ones buying up these 2-3 family properties. They come in with their spreadsheet, and oftentimes they might have immigrated from like Jamaica, or they immigrated from like Dominican Republic or wherever, but they're out there actively, like they're really into this real estate thing, a little bit more so than the stock market per se. So, but those are the people I love to help. But, everybody would get hammered if you got rid of the 1031 exchange. It would be a bad thing. We have to be careful of this because this could collapse the entire, not to say that the real estate market is already fragile, especially the commercial, the office space. This could just, if God forbid the wrong people get elected, this could hammer the market.
Well, it sounds like a nightmare for anyone in real estate. So let's maybe unpack the impact. How would these proposals affect investors and overall economic activity, let's say, if it were to pass?
Well, I would say, let's say a property owner selling $1 million property with a $600,000 gain. And this is something they've owed for a long time. They've nurtured it. They've invested in it. They've fixed leaky pipes. They've fixed, squeaky doors and leaky toilets. And I know people just like this, okay? And the property owner had a $600,000 gain. They would owe $120,000 in federal taxes. Now, what that does is look at the consequence. It limits any reinvestment capital. It goes into the black hole of government. And what's left for them? Right? What's left for them? Why should the government? What did the government do to earn that $120,000?
Nothing.
Right? And here they are fixing up a property, probably not, in a middle of the road neighborhood, trying to revitalize things and make things, palatable for people and who can't, are not exactly rich. And, here you are, you're getting hammered on the tax bill. So I don't think that's very cool.
Oh, my goodness.
And then businesses, the same thing. Retail shops, that would actually hurt them as well. I would just create, I think, a massive stagnation in the market. It would create almost like a depression because there would be very little activity. And then no one would want to sell because they don't want to pay the tax.
I mean, it sounds devastating, Mark, especially for families. I mean,
yeah.
You mentioned carried interest, and I know that that's a hot topic. So how would taxing carried interest as ordinary income affect the real estate market?
Well, a lot of funds, there's a lot of different fund managers out there. They charge a percentage. So carried interest is the share of profits paid to an investment fund manager, and it's currently taxed at a capital gains rate of 20%. And this proposal would bring it up to ordinary as high as 37%. And the impact on property owners, it would be a higher cost for investment funds. I mean, real estate funds would pay more, investors would pay more. They often rely on carried interest to compensate managers, which is what attracts talent. And it would face higher tax costs, potentially increasing fees or reducing returns to property investors. Again, it would just make things no fun, take the fun out of it. Now, when you have an incentive, though, that means, would you rather have one person doing, a small amount of people doing the activity? You have lots of people doing the activity, paying 20% versus 37. At 37, no one's going to want to do anything, right? Or less and less are going to, unless they're forced to do it. It's kind of like our housing market now. No one wants to sell because they're trapped. They don't want to pay high mortgage because they have a 3% mortgage. If you have a 3% mortgage, are you going to be, running
You're not going to
around?
get a 3% mortgage again unless
right.
there's another pandemic or catastrophe or war.
It's an incredible disincentive, which I think would have a serious impact, a negative impact on prices. This is how the system was structured. This is the deal that they went into going in. To pull the rug out from under them in the back end is just not, I don't think, very fair. I think they would actually end up with less revenue if they raised the tax and took it away than they would if they kept it where it is.
Folks, you are listening to On the Mark along with Mark Papa. I'm Gary Byron. Mark Papa, he's got a business in Glastonbury, Financial Resources Group. You can find him online at FR Plan, Financial Resources, get it, frplan.com. And the phone number, remember I told you? Meet with him for 30, 40 minutes. You'll get his checklist. You come back, you review the checklist, and you get a $100 gift card. I mean, it's a win. You don't bring your checkbook. You don't need a credit card. It's gratuitous. You're just it's gonna open your eyes. Get the ball rolling. Meet with him. 860-657-8380. 860-657-8380. And if you missed any of that, I'll repeat it more towards the end of the show in about another 8 minutes. Listen, Mark, let's bring this closer to home because as a financial advisor, you're working with people who inherit money or sell properties. How would these ugly 11 proposals limit your ability to help those clients? And how would it hurt them financially?
Yeah, it would be. Put it this way, just to show how unselfish I am, if these all passed, I'd be a pretty busy guy.
Yeah, I bet.
Because, I wouldn't want any of them to pass. I'd rather that not be the case because people still get themselves in a quandary. I'll leave it at that. But one of the other ones, Gary, would be taxing. They had a proposal to tax to make sure that when taxing unrealized gains at death. Remember, this Congress before wanted to actually tax unrealized capital gains. So let's say I made an investment in a company and my cost basis was $100,000 and now my business is worth $1 million. Before we even sell the business, they wanted to tax that $900,000 on me. That's how voracious their appetite is for tax revenue so that they can spend it for their own political purposes. But then taxing unrealized gains at death, similarly, that would mean that the step up in basis would go away. Now, remember when I told you if you gifted a property that had a low cost basis, it would subject your heirs to capital gains?
Right.
Now, they get to keep the asset from the nursing home. Mm-hmm. In this case, it would automatically cause a massive tax bill on pretty much everybody's death. Oh, any property that would get transferred to you, any stock that would get transferred to you, would now not be at the original owner's date of purchase, not at the original owner's date of death. And that would mean millions of people would have to liquidate these portfolios. It would crash the stock market. It makes no sense, no economic sense whatsoever. So we would, again, so that was actually, we're only on number 2 and number 3, Gary. So I mean, then we got, what, 4 through 11 to go through here. Those 3 things alone would create a depression, in my opinion. So...
it's a grim picture, Mark, and you're painting a scenario where these tax hikes could choke off investment and really hurt families that are trying to pass on wealth. What about small business owners like real estate agents that we've talked about? Or how about landlords who are a big part of Connecticut's economy?
Well, yeah, landlords would struggle, and it would take away their incentive to want to own properties and invest for their future. And I can't tell you how many people I know, and there's some amazing people out there that I know who started with one property, 3 rents. They now have probably 120 rents coming in, and just played the game the correct way, worked hard, no longer works as his regular 9-to-5 job, and just both he and his wife manage their properties. So you have to think about that for a minute. Now, this is not somebody, this is somebody who's ambitious, but at the same time, I met down at the 2008 crisis, and now is got a great long-term income, got a great retirement income, and doesn't have much to worry about. But that guy would be a slave to Social Security and maybe a small pension. It wouldn't have the same lifestyle, wouldn't have the same anything if a law like that were to pass. You'd be hurting people like that.
That's just that's a wake-up call.
Yeah, absolutely. And
so I got to wrap this up. We're about 5 minutes away. So it's a huge wake-up call. Before we wrap this up, though, any silver lining or advice for people listening right now who are worried about all these proposals that perhaps could be coming back?
I think it's ultimately important, even with the tax code today, what's on the books today. If this were, like I said, this were to happen, this would be disastrous, like expanding the 3.8 net income tax, raising capital gains tax rate, limiting or repealing the mortgage interest reduction, imposing a wealth tax on high net worth individuals. I mean, I think most people are okay with number 8, okay? Increasing corporate tax rates never worked because what happened? Everyone moved to Ireland. Remember, they had a 15% rate. Everyone reincorporated in Ireland. People made millions of dollars helping people incorporate in Ireland, and it's a wonderful country. But what Obama actually had to put a stop to it. And all we need to do is a simple equation is let's make sure we're competitive at a corporate level. If we want jobs in our country and we want people moving here, don't raise the corporate tax rate. It's a pretty simple equation. So that's how you incentivize. So you need to incentivize activity, not punish it. And these 11 things would be very, very punishing. Even raising the capital gains tax rate, I mean, even a 20%, even a 15% cut is a pretty hefty slice, right? But no, let's face it. Let's not be greedy. A lot of people out there, like Warren Buffett, for example, sold a whole bunch of Apple. He was happy to pay a long-term capital gain on Apple, But let's not pretend somewhere else in Berkshire Hathaway that was offset. Let's not pretend that it wasn't, because it was. So that's tax strategy. Warren Buffett has the idea. So he says, we were happy to pay a long-term capital gain on it, but he didn't talk to you about where in the balance sheet on the book a giant company like Berkshire Hathaway could find a tax loss to make sure that they didn't really pay much on that. But that's for conversation for another day. And that's what you need to do as an individual. If Warren Buffett could do it legally, you can do it too. So that's part of it. So that's really it, Gary. I mean, that's kind of it in a nutshell.
I've got 2 minutes here. Last week we talked about the retirement stress test, the Three Little Pigs test.
Yes.
Before I completely wrap things up, is this something, this retirement stress test, is this something that you go over with new prospective clients when you meet with them initially?
It is literally, it's kind of like this. You go to McDonald's, it's the same process. Okay, and not to say that, use McDonald's as an example, but it's the same process for everybody. There is no, you get the checklist review, you got the Three Little Pigs test. It's all part of the Three Little Pigs test. It's just for people to get interested in the 21-point checklist or the full checklist review.
I like when you talk about what's truly possible, and then there's the unfortunate reality.
Well, here's the thing, Gary. One of the things we do, like for income planning per se, I can do a whole show on income planning one day. Using a well-designed withdrawal plan after considering 12 different strategies, we may be able to increase, so after there's 12 different ways you can withdraw your money, and so I'm going to give you an example of me versus the competition. Some of my competition, obviously, not all, because it's never an all or none. There's 12 different withdrawal strategies, and this was done by AEIR, the American Economic, Institute of Retirement or something along those lines, AEIR. It's on my website. 12 different strategies, and you get to pick the one that's going to give you the most income, lower your chance of running out of money, and pay the least in taxes. And we can find that. There's so many different strategies available versus just, okay, wait for your RMD, and here's your 4% rule, and live off the 4% of your money, which is, I think, what most people...
Well, that's the unfortunate reality of it.
That's the unfortunate reality. So would you rather have the 12 different strategies that
of course.
Better for you?
Yeah,
or,
no,
hey, just do the 4% rule and we'll talk to you at RMD time and spend all your taxable money first. But that doesn't work.
Before I wrap it up, 30 seconds. People want to meet with you. They want these complimentary second meeting. They want to do this checklist. They like this retirement stress test, and they want their $100 complimentary gift card. Tell us in 30 seconds how they can get that.
Okay, well, first off, let's sit down and do a quick call and figure out what you're going to have some pain points you're going to want to discuss with me. We don't market based on pain points. What we want to do is market on helping people discover what their issues really are and fixing those problems.
Good.
Okay, turn the stones over. 30 minutes via Zoom. We'll do a goals meeting. I'll tell you how things work. We'll sit down. We'll ask you lots of questions, figure out what your goals are. From that point, we'll leave you with some homework. You're going to gather your home insurance, your power of attorney, your statements, and any other things that we may not have discussed. Tax returns, obviously tax returns. Send them over securely or meet in person. We'll get those reviewed. We'll put it in the 21-point checklist, and then we'll have at it for a couple hours.
Very well. If you'd like to do this, I can't see why you wouldn't. Simply contact Mark Papa with Financial Resources Group in Glastonbury. You can find him online at www.frplan.com. It's that simple. Go to his YouTube channel, Mark Papa 5207, MarkPappa 5207. And most importantly, write this phone number down and call it. The show's just about over. Call him right now, 860-657-8380. I'll say it one more time. I'll slow it down. You're missing out if you don't make this phone call. There's no risk to you here. 860-657-8380. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next Saturday morning, have a good one, everybody. So long.